Yeah, it tells us to focus on the fundamentals, and that's why we continue to remain positive on equities for this year, because when you look at the earnings trajectory for equities, it's just gone from strength to strength for 2026.
Is it all because of tech? I mean, is the dispersion so weak where it's all piled into one or two sectors? It's not good math?
It is definitely tech leading the charge, but we are also seeing outside of the Mag 7, the 493 are also pulling their own weight.
I saw recently you took your view on gold down to neutral, and it's down about 18% just since kind of late January time frame. What's the call there?
Yeah, in terms of gold, we think about it as a pause in our views. So that central bank demand story is still ongoing, but the correlations between gold and other asset classes have clearly shifted over the last few weeks. The old drivers of real yields and the dollar are reasserting ourselves. And so in a multi-asset portfolio, we think it's prudent to pause on that view.
Higher, it looks like energy costs higher for, I guess, a little bit longer than people maybe initially hoped, at least. How does that factor into your inflation call, your growth call, and maybe your asset allocation call?
Yeah, in terms of where we stood on February 27th, the day before the conflict began, we definitely saw more upside in terms of inflation risk, but we also saw the economy as running hot this year, and that's what led us to be negative on duration overall. Clearly now that inflation risk has picked up, and that just reinforces our more cautious stance on bond yields for this year.
Equities, we had seen equities performing quite well. We'd actually seen a rotation a little bit in the U.S. equity market starting late last year. Is that rotation into more cyclical, maybe more value-oriented? Is that still a play for you guys?
We're taking a pause on that rotation at the moment because when it comes back to bonds, clearly the driver of higher bond yields has been inflation, bond volatility, the pricing out of central bank cuts, and that is a toxic mix for cyclical parts of the market.
I love it. It's a toxic mix. Yeah. It's not Schroders talk. It's a toxic mix right now. 10-year real yield, I'm sorry, it's a toxic mix. Where is your range bound where there's a breakout? I got the 10-year here, 2.02. It's been 180, 190. Boring. At what point does that come up and get outside its recent collar, its band?
Yeah, we're actually thinking about nominal yields. So if we see a break above 4.5% on the U.S. 10-year, we think that would be the tipping point for equities. So we're not there yet. We do think 4.5 will hold. But if we were to break materially higher, that would cause us to reassess on our equity view.
How does China play into your, Schroders goes back to China. They were there like 1864. How does China play into all that we're talking about? I guess GDP's threatened. Global GDP, I think you get to go up an asset sub 3%. How does China play into all this?
Yeah, when we think about the international markets, we've actually been focused on select economies. So less emphasis on China this year, more on the Asia tech, Korea, Taiwan, where you do have that memory in the semiconductor cycle that continues to power through and support the fundamental outlook that I spoke about with equities.
I think coming into 2026, one of the, I guess, more favorite trades was continued weakness in the U.S. dollar. That's turned around.
Yes.
So how do you think about the currency markets and the dollar here?
Yeah, so we have upgraded our view on the dollar. We like to play the dollar versus the euro. Clearly, when it comes to U.S. exceptionalism, one of the bedrocks of that has been energy independence, and investors are now reminded of that. That being said, if you were to ask me in February, where do I think the dollar would trade, euro dollar, more likely 1.1 instead of 1.15 where we are today. So you still see there is a bit of a political risk premium embedded in the dollar, which we think will persist.
Did you participate in the Korean moonshot?
No.
The Kospi moonshot?
Oh, yes. We have favored Asia tech. And the reason for that is because there is clearly within the AI space in the US, there is clearly a battle that's playing out between the AI winners and losers. When we think about which parts of the market are going to be more agnostic to that battle, we think it's Asia tech, Korea, Taiwan, which has led us to be long those markets since the middle of last year.
Wow. So that's, talk about alpha generating. To me, Cosby's the roulette wheel of Asia. That's what first thing I looked at every morning as well. Quickly here, what is your insight for people scared stiff?
I think the thing to remember is that when it comes to geopolitical shocks like this, they are while often scary in the moment, they are short-lived when you compare it to other sort of shocks like a labor market weakening or higher rates. And so we do just have to bear that in mind when thinking about in the fog of war, we need to focus on what we know, and what we know is the fundamentals at this point.